9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne with David Ingles.
Good morning. We're counting down to the open of markets in Greater China. Our top stories today, stocks across Asia-Pacific trading with a hint of caution here, even as crypto bounces back, in fact, in a big way, 91,000 now on Bitcoin. You do have pockets of risk appetite to underscore the point. Returning China's economy in focus this hour with a fresh private reading on activity in the services sector.
One of China's biggest investment banks says the time has come for authorities to allow further yuan appreciation. We're going to speak with CICC's chief strategist, Miao Yanliang.
And Taiwan's foreign minister weighs in on Beijing's anger with Japan over the island's failure. Chia-Lung telling us exclusively the dispute may drag on for a year. Going into the Wednesday session, we are flat in futures. Could change. We'll see what the PMI reading looks like today. We'll talk more about the sort of broader significance of this private reading in a moment, which normally we don't really spend too much time looking at, but just given the trend of the data recently does underscore, I guess, some broader importance and significance as it pertains to this, us going into the last month of the year. Nikkei's better. When you look at the big movers to the upside here and what's really lifting the benchmarks, although on a breadth basis, I think we're almost evenly split, in fact, if not negative breadth. The big AI plays are back in focus. You're looking at Samsung Electronics, you're looking at SoftBank in Japan, you have Advantest there, among the many names leading these gains to the upside. S&P futures are better by about a 10 to 1% going into the thick of Wednesday. It's a weaker dollar story, and it's quite clear when you look at several of these exchange rates, whether that's dollar China, you look at where the euro is. We talked about Bitcoin. We'll look at that, of course, going into the session today. We're at 92,000. It's been very, very, very volatile of late. Silver futures are still seeing some upside to $60, and gold futures also, as you can see on your screens there, also kicking higher a notch or two. Right, a look at the 10-year yields today. In terms of bond auctions, I believe we have several coming out of Hong Kong. It's worth pointing out when you look at the Chinese and the Japanese 10-year yields, right? So it's something that's crossed recently. Japan now gives you a higher yield, nominal, of course, on the 10-year yield at 187 compared to where you are on the Chinese 10-year yield. We'll talk more about the significance of the broader trend later on in the show. Aussie 10-year yields, I think we're just coming off GDP numbers coming through there. Korea GDP is also out. And in terms of other data, inflation out of Thailand will be coming out in the next few hours or so. Keep an eye on that. And yeah, we talked about the currency and the strength we have seen in the Chinese currency of late.
Yeah, you talk about the technicals, right? That renminbi now topping that 200-week moving average. And we're now set for one of the best outperformances for the renminbi in 5 years. So certainly there's a lot of focus on that. We're going to get to CIC's take on it. Why this new range that we're seeing in the renminbi, it may actually be good in terms of stoking more domestic demand in the future here. Of course, we're still focusing on the weak macro picture, right? When you take a look at what's going on with Vanke and property bonds, that private PMI services data from Rating Dog is going to be quite interesting here today, given the fact that we've seen the official and private gauges have been in contraction for November. And we also have bond sales coming out from Hong Kong, some sales debuts as well. But in the midst of all that, right, when you talk about the weakness in the economy, the Hang Seng Volatility Index, which we'll talk about, is still quite low. This disconnect that we're talking about against macro and markets is still there. Crypto, given the rebound, we'll see how some of these crypto stocks are doing. Car makers and Tesla, just given that we saw those China shipments from Tesla rising for just the third time this year. And the French president also in China as well.
Yeah, let me pick up on several of the points Yvonne was just touching on there and really get into things. Right? So car makers, for example, I think I missed the market reaction yesterday, the negative reaction in the car makers, weak monthly sales. We talked about in Vanke and the weakness that represents in the property sector. And, this distinction between where the market is headed and where the economy seems to be headed again, looking at the PMI numbers coming through, right? So in about, what time is it now? In about 40 minutes or so, we'll get the Rating Dog, the private gauge on services coming out. And the reason that, and estimates bottom of your screens, that's taking on larger significance today on the eco side of things, right? So this is non-manufacturing official PMI coming in at 49.5, the first sub-50 reading a few days back, going back to COVID lockdowns. in 2022, right? So we'll see what that holds later on, but it underscores, of course, the softness that we've seen in the numbers that have come through recently. Of course, that's a survey, of course, and not so much hard numbers. Right. Juxtaposed against market metrics that are pointing to more strength. Dollar China, we talked about this for the very first time in nearly 3 years. We've flipped the chart. It's still dollar China. It's now trading above or below, depending on which one you're looking at, that the 200-week moving average for the first time since about 3 years ago. So really some strength has come through in the currency. And also when you look at equity markets, we'll talk about price in a moment, but the Hang Seng Vol Index is actually now at the lowest since 2021, juxtaposed against an economy that remains on the weaker side of things. So, we're below 18. It's dropped quite substantially in the last few weeks or so. It's now taking you back all the way to 2022 levels. And it just underscores the point. Can this divergence continue? Liquidity, what have you, this barbell strategy where you have non-cyclicals in the middle. You have financials and income, but of course you also have some of the AI and tech plays on the other side of things. But yes, it's really an interesting theme that's re-emerged quite strongly of late.
It's interesting, right? The AI theme seems to be what's kind of leading to that vol to come down, because you continue to see good news on that front, that maybe people are quick to actually pass on some of the risks here when it comes to the macro side of things, because I think it's only the second time that we've actually seen the manufacturing and non-manufacturing gauges from the official PMI be in contraction. I think the last time we saw that was back to the pandemic days.
Both below 50.
Both below 50,
right?
Right? So that's quite significant here. It seems like, just based on headline numbers, that there is this urgency for some sort of policy support. You add that to the fact, according to what we're hearing, that private data providers are being told by authorities to suspend the release of property data.
The monthly one.
Trivium had a very interesting call on that, saying that's an extremely bearish signal, that maybe this suggests that they're running out of policy levers and they're really focusing more on the optics now than really on focusing on improving the fundamentals.
Yeah, well, I mean, to some extent, optics do help, especially when you're obviously trying to facilitate inflows coming through, and a stronger currency does help that, of course, strengthen the case. And we'll really be getting more on this. One of the top red stories today on the terminal, of course, is the write-up of our next guest, or on our next guest's comments coming through at this hour. This time, the next hour, CICC chief strategist, formerly with, of course, SAFE, in that official capacity. He's coming on to underscore and really elaborate on that point, why we should be getting used to a stronger Chinese currency from here on. Catch that interview coming up there. There we go.
But first, let's get more with Bloomberg executive editor for Asian markets, Paul Dobson. He joins us now from Singapore. Paul, just highlight what we just saw here, right? Data seems to see that we're counting down to 2025 with the economy losing momentum. But then again, vol, we're not seeing much of it in these Hong Kong markets. This disconnect, what do you make of it?
Well, Yvonne, good morning. It's not too dissimilar, I guess, from what we're seeing in the US at the moment, with extremely strong equity markets, but an economy that seems to be wobbling somewhat. And I think that the key to that is that people are looking to the future, and they're looking to the AI theme in particular as being a key kind of like support and prop for markets at the moment, which is why we're seeing some of this sort of like slow and steady bull market everywhere. People are excited about the long-term prospects, the transformational impact on the economy that the new technologies are likely to have. I think for China as well, there's a little bit more in play too. You've already got very low bond yields. You've also got the property market in the doldrums. And while that's a drag on the economy, it also means that savers are looking for anywhere where they can get a little bit of appreciation on their investments, and are turning more and more to the stock market. So we've seen a lot of inflows from Chinese people on the retail side, or the wealthy individual side, into the equities market, and on southbound connect into the Hong Kong market as well, all through this year. And so that's been adding to that kind of momentum that has been keeping to support the gains and keeping volatility in check as well. Now, we did have a little bit of a wobble right across global markets not too long ago, and we saw some of those ETFs that have previously been favored by the authorities picking up gains as well. So there's also a little bit of a sense of a backstop there if we do get a severe down drag on the Chinese market, and maybe that also is contributing to that lower volatility that we're seeing.
Paul, it's apart from the obvious themes, it seems very, very quiet on on markets, not just today. And I'm wondering, is it time to look at some of the themes? Have any themes emerged that we should be paying attention to that, normally we won't have, time and scope to do so when things get busy?
Speak for yourself, David. It doesn't feel that quiet to me. But we do have some interesting things going on in the background, right? We've got the Fed coming up quite soon. People talking about who the next Fed governor is going to be, what that's going to mean for the US yield curve and for government bonds everywhere. We've got steepening yield curves in the US. We've also got steepening yields in Japan because the BOJ is taking so long to raise interest rates that people are worried about inflation. They're worried about supply in the bond market as well, and so that is sort of seeing that general lift in interest rate markets all around the world. I think another interesting theme that we've been going on in the background all the way through this year has been that of the internationalization of the Chinese yuan, and we see another example of that this week where we have Russia selling bonds denominated in yuan, raising some money there, setting a little bit of a benchmark so that corporate issuers can also take advantage of the Chinese currency that's washing around in the Russian economy at the moment and being able to put that to more use. And I think that, we will continue to see more bond issuance in renminbi all around the world into next year as well, which I think is, an interesting sort of more of a slow burner, if you like, if that's what you're looking for, me to be talking about, but a long-term trend. And, that sort of idea of using the currency as a way of expanding influence, building connections with trading partners and with allies around the world is something that I think that China will continue to push. It's sort of talked about it as being part of that long-term goal for their 5-year plan as well.
Paul, thank you. Paul Dobson in Singapore for us on the key market themes to watch today and beyond. Just very, very briefly, where Paul is, of course, we are looking at the biggest non-REIT listing debut in Singapore. Ultra Green AI shares, I think we were trading at about, it was 145 a pop. Was the offering. Let's call it 160 right now. So better buy, let's call it 10%.
Ooh.
First day of trade. There we go.
Fluorescent technology used in surgical imaging. That's what they do. But yes, interesting that it's not part of the REIT space, which really make up about, 10% of the market cap in Singapore there as well. So yeah, exactly what the SGS CEO told us just a few weeks ago at NEF. More interesting IPOs in the pipeline there. Still ahead, we have our exclusive interview with Taiwan's foreign minister who sees tensions between China and Japan over the island's future dragging on for many months.
It's not just a different policy change from the Japanese side, but for Beijing side, maybe take maybe a year to stabilize the situation.
Some world news, this morning, Russia has dashed hopes of immediate progress towards a Ukraine ceasefire deal, saying that talks in Moscow between President Vladimir Putin and U.S. envoys could not reach agreement on what the Kremlin calls territorial issues. Now, Putin met with Steve Witkoff and Jared Kushner for almost 5 hours. His foreign policy aide says wording of some U.S. proposal is not acceptable and work will continue. Now, Axios says that a U.S. team is expected to meet Ukraine's president somewhere in Europe after leaving Russia. Right. French President Emmanuel Macron begins a 3-day visit to China today, something we're tracking, of course, with the Taiwan issue expected to take center stage. And ahead of Macron's meeting with President Xi Jinping, Beijing has been seeking support from France in its dispute with Japan over Taiwan status. Now, trade will also be on the agenda, with Macron pushing the EU to deploy its toughest tools in response to Chinese restrictions on rare earth supply.
All right, tracking some live kind of comments here when it comes to the Korea president, Lee Jae-myung. He's speaking in Seoul this morning for the past couple of minutes now. He talked about the economy earlier, but now he's kind of focusing a little bit more on the geopolitics, in particular when it comes to this China-Japan spat. In terms of South Korea's perspective, they said the country shouldn't side with China or Japan in this dispute, and South Korea should seek ways to mediate so the nations can coexist. So a bit of a diplomatic sort of response there from the president here this morning, Dave.
Yeah. Okay. Well, that takes us into what we're focused on in the next couple of minutes. Taiwan, of course, says it's confident that the Trump White House will eventually allow the president there to make a U.S. stopover on his way to visit diplomatic allies in Latin America. Now, President Trump denied the request for Lai to pass through the U.S. in August on concerns it could disrupt trade negotiations with China. Let's take it out to Taipei, and our chief North Asia correspondent, Stephen Engel, is there, who spoke exclusively with Taiwan's foreign affairs minister. Steve, it takes me all the way back to August and what didn't happen back then. Lots to unpack, including Trump, of course, signing this bill that aims to deepen Taiwan and U.S. ties. What do we know about that?
Yeah, there is lots to unpack. Let's start with that one first, because this is a bill that was proposed by a Missouri Republican representative, essentially to shore up America's commitment to Taiwan. Of course, Taiwan-U.S. relations are governed by the U.S.-Taiwan Relations Act, and then sort of in practice by Washington, this strategic ambiguity. So this is essentially a bill that Donald Trump did sign within the last few hours, I do believe, essentially to deepen that partnership, if you will, with Taiwan that would basically dictate the State Department to make reviews at least every 5 years to policies towards Taiwan that are aimed at boosting and improving relations with Taiwan. This comes at a time, of course, within the last couple of weeks that Donald Trump spoke again with Xi Jinping, where Xi Jinping essentially, re-emphasized the importance of Taiwan's reunion with the mainland. However, the White House readout of that call did not mention Taiwan. Meanwhile, of course, the big overarching story behind all of this is that fracas between Beijing and Japan over Takeichi-san's comments about Taiwan. This is what the Foreign Affairs Minister of Taiwan, Chia-Lung, basically said to me in an exclusive interview in Taipei.
So we have very good communication channels with the Japanese government. So we are trying to manage the situation to avoid it's become a situation out of control. So because...
So are you saying you're downplaying it? Because
yes.
The response so far from Lai Ching-te, the president, has been fairly muted.
Yes. So we show our support through a soft approach, suggesting that our people to travel to Japan, also to eat Japanese food. So we want to help cool down the situation, because once the Chinese nationalist sentiments stimulated, it will very, to some extent, out of control. So I think for Beijing, it also not in its interest to escalate the conflict.
What are you communicating to Tokyo? Do you want them to back down to cool tensions or stand ground?
I think it's in everyone's interest to stabilize the current situation, because once Xi Jinping mobilize its society through nationalist sentiment, it's also not in Xi's interest, because the economic downturn and also the high the rising unemployment rate, and also the trade conflict with the United States. So I think it's not in everyone's interest to have the China-Japan disputes on the issues related to Taiwan to escalate.
So by not provoking Beijing, you feel, this is the way I'm reading it, you feel that this could die down sooner?
Yes, I think so.
How long?
Because I think Japan has already shown its willingness, because it's in the parliament, it's in the QA session. Yeah. So that has some backgrounds. So it's not just a different policy change from the Japanese side, but for Beijing side, maybe take I think maybe a year to stabilize the situation. But for saving Xi Jinping's face, he has to do something to show his domination in the disputes.
As you mentioned, right, this might prolong for a few months. Steve, we also understand Beijing is well aware of your interview with Minister Lin. What's been China's reaction so far?
Yeah, well, first of all, this was the first interview with foreign media for the Foreign Affairs Minister, Lin, yesterday. So his comments were closely watched. The Nikkei newspaper in Japan picked up our story. The Taipei Times here in Taiwan picked up the story. And also a question was asked of the Ministry of Foreign Affairs in Beijing about that story. And Beijing was quick to essentially say Taiwan is part of China and there is no such thing as a so-called foreign minister of Taiwan. They also took the opportunity, if you will, to slam the efforts by the ruling party, the DPP here. And this is what the Ministry of Foreign Affairs spokesperson in Beijing had to say yesterday afternoon.
The DPP, Taiwan's Democratic Progressive Party authorities, harbour malicious intentions which are contemptible. Their attempts to seek independence by relying on foreign forces are doomed to fail.
So, guys, in the next hour, we're going to unpack further that exclusive interview with the Foreign Affairs Minister of Taiwan, Mr. Lin, and talk about his efforts in Europe. He's been to Europe 3 times in the last several months, and also just in the last month, the Vice President, Xiaobi Kim, gave an address to the European Parliament. So, again, there's diplomatic efforts abroad with like-minded economies and like-minded nations to garner some support for Taiwan.
Steve, thank you so much. Stephen Engel, our Chief North Asia correspondent in Taipei for us. We had a very punchy fix, but there's a bit of a qualifier to that. We'll talk about that in a moment. The clients going into the session today. This is The China Show. Welcome back. We've been talking about the stronger currency of late. So 2 things on the fixing today. It was on an absolute basis the strongest fixing going back to October of last year. We'll get to more of this. In fact, my chart doesn't go all the way far enough to talk about that. But yes, a stronger fixing. But compared to estimates, you probably saw that headline, the weakest bias on the setting compared to the estimate and that spread between the two going back to June of this year. We put that on a chart for you. 89 basis points is the spread between those two things. You're watching The China Show. The Open is coming up. This is Bloomberg. Good morning. Welcome back. You're watching The China Show. Just over 40 seconds to the opening bell. Looking at some weakness coming through across futures and initial pricing. We're below 26,000 on the Hang Seng Index. Weaker bias in the fix. Yvonne, we'll talk more about that in a moment. And in about 15 minutes or so, the private gauge on services PMI comes out. The estimates are for 52, above 52. The official non-manufacturing number, though, came in below 50. So we'll see whether that divergence closes, in fact, along those lines.
Yeah, hopefully it bucks the trend, right, from what we've been seeing, which has been continued slow softness when it comes to some of these PMI gauges, whether you look at official and private this week. So, certainly we're looking for signs of maybe still some resilience when it comes to the services side of things. But then again, as we talk about, the macros are getting weaker, but vol still remains quite low when it comes to this equity market, particularly when it comes to vol that you're seeing on Hang Seng. So certainly can this disconnect and this sort of dichotomy between markets continue and the macro side of things? That is a key question as we count down to 2025. In terms of mainland open, this is what we're looking at. It's pretty slow going here so far. We're flat when it comes to the CSI 300. Only Shanghai's slightly to the downside here today. Keep in mind, though, it's interesting to watch how the bond space is sort of evolving, right? We did get confirmation the PBOC did buy bonds for a second straight month. And given just how weak the data has been in November, you have the likes of Capital Economics say, expect record lows when it comes to those yields, particularly when it comes to the Chinese 10-year, given those two combinations of PBOC buying as well as the weakness in the economy. So Chinese 10-year yields are at 1.8 right now. I think we once reached 1.6 earlier this year, so they're thinking we are heading in that direction here so far. And we're watching very closely what happens with the renminbi as well. But for the most part, there hasn't been that much in terms of catalyst here as we count down to the end of the year. You're not seeing that much movement in some of these big plays here this morning. Copper, even despite reaching those record highs this week, we're coming off that just a little bit. Shanghai crude, though, is lower by about 1% or so. You flip the boards, though, we're focusing on the currency, as Dave mentioned. So that was the weakest bias for the FIX that we've seen since June. So given the strength that we've seen, maybe we are seeing a little bit of weakness here today, but we're still hovering about 706 levels here, still on track for the best performance for the renminbi in 5 years, and really defying all these trade tensions that we've seen all year as well. We're going to get CICC's takes on it. Mr. Miao is going to talk a bit more about why the time is now for this new range and the strength in the currency to persist, because it is now time to really kind of focus on domestic demand. Maybe with a stronger currency, you can get people to import more, buy more, spend more, and the like. So there you go. We'll get more on him coming up there. He's coming up at the top of the hour. But then again, the tech space seems to be selling off here in Hong Kong. We're lower by about 0.6% for HS Tech. That's dragging the Hang Seng lower too. We're just under that 26,000 level here. In terms of sectors to watch, we are focusing on maybe Tesla suppliers, because it's only seen their car sales rise, I think, 3 times this year. So we are seeing with some of these suppliers, they are looking okay here today. The likes of Lens Tech is up about 0.6%, but CATL, H shares are basically flat here right now. But you're still tracking, of course, Vol, Dave, and the like.
Yeah, I mean, just to juxtapose that, Vol, ideally, when you look at it theoretically, should not be trading this low given the weakness that we're seeing in parts of the economy. Yvonne talked about Tesla suppliers, and Tesla's up, 3 months in a row only. I think this time yesterday we were looking at negative market reaction to the weak monthly car sales, but yet here you are with a metric on markets trading at about the lowest in about 4 years or so. And I guess there's divergence between the equity market and where you are with some parts of the economy. That is just to say, should we remain constructive on Chinese equities despite some obvious headwinds? And why should we remain constructive on Chinese equities going into next year? To help us answer that question, Bank of Singapore is here with us on set to talk us through that very thesis. Favorable tailwinds remain intact. Joining us here on set, China equity strategist at Bank of Singapore, Louisa. Good morning. Very nice to see you.
Morning. Yeah, thanks.
So why?
I think favorable tailwinds are mainly coming from 3 to 4 areas. First of all, in the macro front, like what you have just mentioned, RMB has stabilized, and with modest appreciation bias, we forecast RMB to stay at 6.95 over a 12-month horizon, and that has been supportive usually for MSCI China over the past decade or so. Secondly, when we focus on the fundamentals, we see some signs of earnings stabilization. For the offshore market, we've seen some of the earnings revision momentum has stabilized, and we're tweaking some of the upward earnings revision momentum more recently, especially we see some of the peak in terms of food delivery and quick commerce competition, investment and subsidies peaking in the September quarter. We're not saying that the competition is end, but the peak investment and subsidy probably would have passed, so that would be supportive. Also coming back on the fundamental basis is return on equity has already bottomed last year in 2024. We are seeing some of the index-heavy sector would likely to benefit from a ongoing recovery of the ROE. For instance, the advanced manufacturing that has been focused by the policymaker, also biotech. So that actually fits into the communication services, consumer discretionary IT sectors. The anti-involution initiative also has been supportive for the materials sector as well. And to our surprises, financials, we've seen very resilient earnings, and especially for non-bank financial as well. That's also being reflected in the A-share market earnings in 3Q. That's bucked the downtrend.
Okay. How critical is it then for earnings to actually have to drive 2026? Because we were talking about how it's really been a valuation sort of story for 2025, and liquidity, but that's also getting a bit tired now, that sort of theme.
If we look at 2025, bulk of the performance in the Hong Kong China equities market has been driven by valuation re-rating. We are now probably, I would describe it as a normalized value, hovering plus within the range of plus 0.5% standard deviation to historical average to maybe plus 1 standard deviation for the onshore market. So the next focus will be earnings. So for this year, we are looking at 2025 low single-digit earnings growth. Going into 2026, we are seeing some confirmation of the positive trends like what I have mentioned. So that will give the market a more comfort looking through into 2026, which the market is now forecasting a low teens sort of earnings growth momentum.
In your report, you've highlighted one specific economic metric, which is producer prices. My producers are about to put that up on a chart, including a tracker that sort of attempts to throw that forward. What's the connection? What does that have to do with equity markets, and why is that, do you think, a positive catalyst? Because that's still deeply negative in my view. Look at that.
Well, the market usually look at both CPI and PPI as a gauge to inflation or deflation. So the focus of PPI here, or we treat it or see it as a proxy to whether deflation is easing. We are seeing that has been narrowing, and I think the market is forecasting by 2026 it will further narrow to maybe minus 1%. If any further acceleration in terms of the narrowing of the PPI back to neutral or positive territory, that would suggest the deflation pressure easing. That is actually very positive for the revenue growth.
Understood.
You mentioned one of the tailwinds is policy beneficiaries. Anti-evolution certainly mentioned a little bit of that. I think so far we've seen that really benefit the material section, as you mentioned, but maybe not so in other parts. Are there other parts that you're tracking for next year where we might actually see more of that ROE emerging?
I think this time around the focus is slightly different from what we first seen maybe 5 or 7 years ago. This time around, not just the upstream sector, but more on the mid to downstream. So notably, within the material sector, some other sector that could potentially benefit more from the anti-evolution initiative, including, for instance, like solar, lithium. We are talking at the subsector level, but in the midstream, I think one of the focus will be, like, for instance, NEV. That has been a lot of competitions in the onshore in terms of production volume, so on and so forth. So that we are talking about more mid to downstream, that sort of sectors.
Okay. One question we've been asking a lot of our guests, and this is hypothetical because we don't know what's going to happen. If the U.S. AI story corrects next year, case in point, if the S&P 500 corrects next year, what is the correlation between what happens there and Asian equities, and specifically Chinese equity benchmarks? What relationship does that have?
Okay. I think we can look at it from two levels. First of all, from the overall market correlations. I think across Asian equities market, Hong Kong and also offshore and onshore Chinese equities market has the lowest correlation. I think historical data have shown that Korea, Japan, and Taiwan, they have relatively much higher correlation with S&P 500. So at this level, if this scenario pans out, like what you have described, the onshore market, i.e. the Asia market, will be the most resilient, and we will probably change our tactical overweight or preference on a relative basis. Currently, we prefer the offshore market because we do believe the Fed rate cut cycle could benefit more for the offshore equities. And secondly, our offshore markets still have quite a sizable of the internet and platform plays that we see them as the core AI proxies. Now, the second level that we can look at it is, first of all, from a valuation perspective, all these AI proxies or internet platform companies across the board, they are trading at a discount versus US and global peers. That's one thing. Secondly, they are more domestic focused, I would say. And lastly, I think a lot of concern is regarding cash flow in the US part or the developed market part. Whereas in China, many of the leading players, they are either in net cash or their operating cash flow would have still be positive. I mean, 2025 is an exception because of the food delivery and the quick commerce competition. But looking at the forecast, going into 2026, all these operating cash flow will see a rebound, and they are still remain in a positive territory. So I think that's a major difference.
Is there still a need to be defensive in this market? In terms of quality plays, we've seen, at least when it comes to dividend yields, that's compressed a bit. Is it still worth having in your portfolio?
The short answer is yes, for several reasons. First of all, yes, the dividend yield has come down. But the other thing that we also look at is the yield spread versus the China 10-year bond yield. If you look across the board, for instance, which is like this banks or telcos, so on and so forth, they are still trading at 400 basis points plus versus China 10-year government bond yield. I think market is still looking at around 1.6, 1.7%, that sort of level for the China 10-year bond yield, and that will be the buffer that I will be focusing on rather than just look at the dividend yield on its own.
Final question. You mentioned return on equity earlier, and that's one of the factors why you like the market. Why do you think that's been resilient, and what do you think keeps return on equity positive next year? Speaking of just dividends, and is that down to returns to investors of cash in terms of dividends, or is that price in the market?
I think ROE in the long term, that's what, especially for institutional investor, that they will focus on.
Right.
And in the long term, that will correlate with the valuation, more notably on price to book. And when you decompose the ROE, there's several factors. Margin is one of those. So we're expecting earnings and margin recovery. That's one of the drivers. Asset turnover, yes and no, because China has not been over leveraged market from this perspective. Shareholders' return that has been improving. We are seeing, especially from a dividend payout and also from share buyback, especially by some of the index-heavy internet names. They are still conducting doing the share buyback.
Louisa, thank you. Louisa Falk there, China equity strategist at Bank of Singapore. Coming up, a week after Hong Kong's worst fire in decades, we'll look at how claims of ignored warnings are stoking renewed political tensions in a fresh test for Beijing. This is Bloomberg.
So the data that we flagged earlier has not come out. This is the private gauge on services, and it's, to Yvonne's point, actually bucked the trend.
Yeah.
We've seen a series of sub-50 PMI numbers of late. This one seems to be bucking the trend, which is obviously encouraging to that front. At 52.1, in line with estimates, slightly lower from the previous month's read.
All right, at least some good news on that front. We take a look when it comes to other news that we're tracking for you this morning. Taiwanese prosecutors have charged Tokyo Electron with failing to prevent staff from allegedly stealing TSMC trade secrets. Now, they're asking a local court to impose a fine on the company for neglecting its duty to stop the alleged theft. Tokyo Electron says it is still verifying the details that the indictment targets its Taiwan unit. And shares in Danish management company ISS slumped amid concern over its role in renovating the Hong Kong apartment complex, where a fire last week killed more than 150 people. A unit of the firm was serving as property manager of the estate. The company says its role was limited to arranging services from third parties appointed by the building's owners, and it made no decisions on the renovation.
And it's been about 1 week since the tragedy, and authorities are continuing their investigations into really what caused the fire. And the signs of ignored warnings are starting to stoke more public anger. Let's bring in Min Lo, our China correspondent. And we are getting more information about these warnings, all these warnings that seem to have been missed. What do we know specifically?
Yes, and this is based on our Bloomberg's team. Our team's reporting after extensive interviews with dozens of residents, and it seems like there were lapses on multiple levels. As early as 2016, this was when the building was up for inspection, because under Hong Kong law, any buildings above 30 years old need to go through inspection. So willpower architecture was brought in, and they have assessed the building, they decided what needed to be done, and then Prestige Construction won the bid. And during that time, residents were already upset at the price they had to pay, 160,000 Hong Kong dollars, which they felt was too expensive. So they had written to the anti-corruption agency.
This is per resident.
Per household.
Per household, okay.
So they wrote to the anti-corruption agency to investigate this, whether there was any corruption involved, any bid rigging, because local media reports say that the entire industry is very ugly. It's very common for example, construction companies to set up multiple companies run by the same bosses, and they all put in bids. They're predatory pricing, where they bid very low prices and then add on a lot of additional unnecessary costs, for example. But anyway, they already, alerted the Corruption Bureau to this. And then later on, when construction started, they noticed the materials, including the styrofoam boards, the netting, and they raised concerns to the companies involved, both the consultant and the company. And they were so angry that they, in fact, had lit a styrofoam board on fire in a public meeting with the owners' committee, just to show how quickly it catch on fire. But again, their warnings, the concerns were dismissed. They wrote to the Department of Labor as well, and again, they were told that the materials were compliant, and they were so angry they actually overthrew the owners' committee that was overseeing the entire process. And the Department of Labor visited the site 16 times. They didn't find issue with the netting because we knew the contractors were very smart. They wrapped the base of the buildings with compliant materials. Only the ones at the higher floors were non-compliant. But they did find other fire safety lapses. So they fined the company. They had issued multiple warning letters. And yet, here we are, right? So there are a lot of questions as to, first of all, whether the inspections were effective, whether the rules were strong enough, and why wasn't investigations done ahead of time?
Yeah, amidst all this sort of grieving, you're seeing a lot of public anger, whether, questions about accountability and the like. Tell us a bit more about the political fallout that we've seen, and how is this in any ways, striking up any unease when it comes to Beijing?
Yes, certainly. I mean, yesterday during this press conference that John Lee had held, he was asked pointedly by a reporter whether he should deserve to stay on as chief executive. Of course, he sidestepped that question, but it's been a long time since we hear such questions, right? The last time there were very public calls for a chief executive to step down was in 2019, 2020 during the protests, right? And then after that, the national security law came in, and those voices were largely silenced. So we have heard that question being posed to John Lee explicitly at the press conference. And certainly, I think people will be watching the Legislative Council elections coming up on Sunday. Of course, it's not necessarily going to be reflected in the results because it's a Patriots-only electoral system now that is imposed by Beijing. But yes, there is some level of public discontent, and we can feel the anxiety from the government. If you watch yesterday's press conference, you hear the conviction in John Lee's voice when he talked about, how important it is to arrest people who are using this incident to sabotage it and to take advantage of this incident for their own political purpose. And police presence had ramped up at the site near the fire. Volunteers were asked to clear out. The government is taking control of the donation drive just to ensure that, that public gathering and the public display of grief doesn't turn into anger.
Min, thank you. Min Lo there, our China correspondent with the latest, and we'll have more coming up. This is Bloomberg. Some other corporate news this morning. JD.com's supply chain technology unit has started taking investor orders for a Hong Kong IPO that could raise more than $420 million, capping more than 2 years of efforts to go public. Beijing-based Jingdong Industrials is set to list its shares on December 11th. It keeps Hong Kong's IPO market on track to see listing proceeds notch a 4-year high. Tesla's China factory shipments rose for only the third time this year amid a global sales slump. Tesla shipped about 86,000 vehicles from its Shanghai plant in November. That's up 10% from a year earlier. It was the second highest monthly total this year, behind September. The gain, though, is a rare bright spot for the EV maker as it faces subsidy cuts in the U.S. and a likely second straight annual decline in sales. And Shanghai says it's removed over 40,000 online posts related to property as it tightens oversight about what it says is misinformation. The city's cyberspace administration says it's working with platforms including Xiaohongshu and Bilibili. Authorities say over 70,000 real estate-related accounts have also been dealt with. And there's much more coming up when it comes to China property ahead. We're going to talk to UBS Investment Bank about their new report looking at the bank and really what their exposure to the property market is right now.
Right. Just a brief look at earnings before we wrap up the first hour of the show. Alibaba Health earnings estimates raised at JP Morgan. Shares are down 1.3. There's a debut in Singapore today. It was doing quite well last we checked, up as much as 10%. The largest non-REIT debut in Singapore, I think going back many years, 2017 coming up on your screen. It's still doing very well, 8.3. Samsung C&T is the biggest mover to the upside on the MSCI Asia Pacific. This is down to, we are getting more shares coming through of JY Lee from his mom. That's just to say a lot of details missed there. But yes, that's the headline there. And Shenzhen Transmission, speaking of IPOs, has filed for a listing in Hong Kong. Shares are down 6.7 in mainland China. Those are the big movers to tell you about at this point. There is plenty more on the way in the second hour of the China Show.
Welcome back to the China Show. Here's a look at the HSI half hour into the session. It looks like we are extending declines here this morning, just half an hour into the trade. We're down about 1% when it comes to 8 shares here this morning. HS Tech also is lower by 1%. So certainly a little bit more pressure when it comes to the equity market in Hong Kong here today. You flip that with what you're seeing in Shanghai and onshore markets. They're looking, relatively speaking, a little bit more resilient in the face of all that we're seeing. So there you go. You see Shanghai Composite is slightly just down. CSI 300 is actually up this morning as well. And we're focusing a little bit more, not just on the equity moves, but really has been on the currency of late. This had a quiet appreciation of the renminbi, which we really haven't been talking about up until recently. We're back to 706 levels here right now. You're getting more a chorus of economists and FX traders out there that say that we could be seeing a sub-7 handle or around 7 for next year. We did see when it came to the renminbi fix here today, it was a weakest bias since June, but then again, we're still talking about quite a bit of strength when it comes to this currency here right now. And, why now is a time, perhaps, for a lower trading range for dollar China?
Yeah, it's silently caught up, right, at 706. And if someone tells me that's a weak U.S. dollar story, all I'll tell them is look at where the yen is trading and look at where the Indian rupee is trading. And it's not a weak U.S. dollar story,
Good
right?
point.
I think when you look at the currency against G10, it's really outperformed the G10 space. This is the last 2 months. Effectively, it's a look at quarter to date. And of course, as you can see, the currency has strengthened against all G10 peers and quite a bit, especially against the Japanese currency. Now, on what we've observed as this silent but meaningful shift in the Chinese currency and a fresh trading range, we did speak to many of our guests about the very topic. Have a listen to some of the latest that we've heard so far on the Chinese currency.
RMB has stabilized and with modest appreciation bias. We forecast RMB to stay at 6.95 over a 12-month horizon, and that has been supportive usually for MSCI China over the past decade or so. Secondly, when we focus on the fundamentals, we see some signs of earnings stabilization. For the offshore market, we've seen some of the earnings revision momentum has stabilized.
The RMB, from a valuation perspective and competitive perspective, you look at China's exports, and even especially if you do product by product, it is extremely competitive. It is on the low end of valuation. We've seen a very long stretch of real RMB depreciation, the longest one actually since the 1990s, or actually the largest one in terms of magnitude since the 1990s. Extremely competitive. We're just looking for a catalyst.
Yeah, and that's really showed up in the form of a stronger fixing almost on a day-to-day basis, right? So even the fix today, which had a weaker bias relative to estimates on an absolute basis, this is a chart that tracks the daily midpoint. At 707.54 is actually the strongest going back to about October of last year. That's point one. Point number two is when you look at dollar China, weekly charts, it's the first time we're trading and we've broken through the 200-week moving average. On that, I've reversed the axis for you, but that's still dollar China. That's just to say, of course, we've taken out a key technical level for the first time there, Yvonne, since 2023. And of course, also just to mention to this generational shift we've seen, right? juxtaposed against the shifting yields that happened this week, or very recently. 10-year yields in Japan are above China's, of course, so a very low rate environment and might actually bode well in terms of supply and issuance moving forward.
Yeah, we're just talking about capital economics. Their call that maybe we could see that 10-year yield in China get back to record lows of maybe 1.6% that we reached earlier this year, given the PBOC is buying bonds once again, given the weakness in the economy. But yes, the need for stronger currency certainly is one of the big stories on your terminal here today, one of the best read stories that we've seen here in the region. Joining us now is, of course, behind that call from CICC, Yanliang Miao, Chief Strategist at CICC. Dr. Miao, it's great to have you back on the program.
Great to be back.
You argue that the timing is now for policymakers to allow for a stronger currency. Just tell us in terms of the timing, why now?
Yes. Well, I think, if you look at renminbi at real effective terms, that's what determines, a currency's competitiveness. We shouldn't focus very narrowly on the nominal exchange rate. We should probably look at the real effective terms. On real effective terms, renminbi has been on its weakest since 2012. Yeah. I think for the past 10 years, it's depreciated about 16%. On the other hand, if you look at the US dollar on real effective terms is the strongest in the almost past 40 years. We know this year is not a particularly good year for the dollar because in the beginning of the year, in January, the DXY index hit 110. Now it's about 100. It's not a weak dollar yet, but I think, if you really look at the exchange rate, you should focus on real effective terms. So that means the renminbi really has a good purchasing power. The purchasing power, in easy to understand terms, you can look at the Big Mac index. You can look at, now people look at, that's McDonald index. Now people look at the Four Seasons index, right? Four Seasons hotel index. New York and Washington, D.C., the standard nightly rate is like almost $2,000. But in Beijing, it's like $200. So that shows that renminbi has a lot of purchasing power. As regards to the question, why now? I think, there are three forces joined together. Fundamentals, you see how competitive the Chinese economy is, how resilient it is. And then policy-wise, I think both PBC and U.S. Federal Reserve are under pressure to ease. But probably, the Federal Reserve going to move even on bigger terms. News just break out, they probably have a new Fed chair. And then last but not least, we also need to look at the positions or capital flows. This is towards the year end. Towards the year end, I think there is some currencies or export revenues need to be shifted back to homeland. So all in all, I'm saying is exchange rate should be determined by market forces. And then all these three market forces, whether it's fundamentals or interest rate or it's the positions, capital flows, they just maybe towards the year end. They just amplify and combine each other. That's make it a good timing to let market decide. Market decide doesn't mean it's just one-way trade, right? Market decide means it can be a two-way volatility. It can be, a stronger renminbi. It can be also at times, if the tide shift, and it can be also a weaker. It doesn't mean just one-way straight up. Yeah.
Won't a stronger currency run counter to the efforts to reinflate the economy and looking at price pressures? Isn't that deflationary? And how do you square those two things?
Definitely. I think this is the biggest concern that if you have a classic textbook will tell you, if you have a inflation problem, right, deflation problem, you need to have weaker currency, right? But what I'm saying is, there's no magic bullet or panacea. Exchange rate is definitely like a panacea for everything. Exchange rate is just mostly for external balance. So that we shouldn't read it in isolation.
Okay.
We should, you should have for China's low inflation. The key really lies on fiscal expense, on fiscal stimulus. So combined with monetary easing and the fiscal stimulus, then you will have both higher inflation, also a stronger currency. Only that is possible. If you look at how the U.S. get out of the low inflation post-COVID, it's both monetary easing and the fiscal easing. But they probably have they probably overdid it a little bit, so they have inflation too high.
Yeah.
But before COVID, for the 10 years, they tried everything, mostly on the monetary side, from QE1 to QE4. Inflation was subpar. It was never above 2%.
Yeah.
Only with a big, massive fiscal easing, U.S. finally hit, above target. And then in the initial stage, people's response was that, wow, they have huge fiscal easing, fiscal deficit. That means a weak dollar. It turned out not to be true, right? Dollar is we have a strong dollar, not rather than a weak dollar. That shows if you have fiscal easing, we actually not reduce interest rate. You will actually kick the interest rate up. That helps attract capital flows. That help, a stronger currency. So my advice or suggest is really you shouldn't take in isolation. It's a combination of monetary and fiscal easing. Only in that case you will have a stronger renminbi and also get out of the low inflation zone.
What sort of pace of appreciation do you think is appropriate? Because there is this concern that this could actually hurt exports, which could then weigh on growth at a moment when exports is something that is still quite resilient in this economy.
Yeah. 20 years ago, there was an argument that because on average Chinese export, the profit margin is only 3%. So the argument goes that, the appreciation pace should never be above 3% a year. That argument turned out to be, proved to be very wrong because you see that Chinese export doing so well. That argument, it's average doesn't mean everything. There's some companies doing very well, is above average. Some companies doing, not as well as average. This is the market forces, right? The strongest, the fittest survives. So I think it's similar today. I think Chinese companies are so competitive, a very modest appreciation wouldn't hurt their competitiveness. Similarly to the argument that David just mentioned, a gradual, appreciation, I don't think it would be a big headwind to inflation as well.
This helps I want to talk about the broader, longer-term effort to internationalize the currency. And certainly a stronger one, a more valuable one, pushes that narrative. I think there was news, we talked about this during the commercial break, Russia was issuing Yuan bonds, of course. And I want to get to, when do you think, and what needs to happen for the Chinese currency to become, at some point, a reserve currency?
Yeah. Well, I think Chinese currency is already a reserve currency. It's not a dominant reserve currency yet because, renminbi joined the SDR basket 10 years ago. So if you're in SDR basket, you are de facto a reserve currency.
Okay.
But you're not a dominant reserve currency. The share is still very low, like 2 to 3%. For that to happen, I think, a few things. In the past, there were two headwinds to renminbi internationalization. Number one is renminbi is a high interest rate currency. Chinese 10-year bond is like 3 to 4%. US was a low interest rate. So for foreigners to issue bond in renminbi or to borrow in renminbi is very costly. Now that has shifted around. Chinese 10-year bond is 1.6 or 1.8% today. So it's cheaper to borrow in renminbi. So that's from headwind to tailwind. Number two, for the past several years, renminbi has been under depreciation pressure because of the interest rate gap. US is high interest rate, now US is low interest rate. Now I think, this year, renminbi is under pressure to appreciate. So if you want to hold a renminbi asset, you want it to be an appreciating currency. So I think that has also shifted. Renminbi is now, show more promise to be a, appreciating currency, supported by fundamentals, by competitiveness. So maybe, if I want to add one more point, is really we need to, I think we can, open up further, a two-way street. Foreigners can access Chinese market much easier, and the Chinese resident can access Hong Kong market, through this two-way connect. And then there is also a technical, but important technical issue. Many investors I talk to, they also complain that, there's not many Chinese bonds to be bought.
Okay,
yeah,
supply issue.
Yeah, supply issue. Because a lot of Chinese companies or commercial banks, they are in this buy and hold mode. They buy the 10-year Chinese government bond and they hold on the balance sheet. So they don't change hands. I think we should issue more bonds, both on the domestic market and the offshore market, to supply the safe assets. Yeah.
You also mentioned when it comes to why we need a stronger renminbi now is the need to stoke domestic demand, consumption as well. We heard a little bit of that in that 15-year
plan.
15 5-year plan.
Yeah.
What needs to be done still to boost consumption?
Yeah, I think consumption is really a function of two things, right? It's how much you earn and how much you plan to spend. Both depends on expectation. Now, on income, it's really three things. It's your labor income, your asset income, and your transfer income from the government. Now, labor income is around 60%. I think to boost labor income, you really to have a strong job market. But I want to focus on the second bit, is the transfer income. The transfer income represents 20%. I think the transfer income has slowed down very dramatically in the past 2 years because of local government difficulties, because of land sales has, almost halved. Land sales has come down huge. So I think, that's also linked to my previous argument that central governments need to step in to do more fiscal easing, to help local government, to help the transfer income. So that's on the income side. And then on the willingness to spend, I think we are still 2 cents in terms of marginal propensity to consume. So in the average Chinese, they earn $1. Before COVID, they spent 68 cents. Today, they only spend 66 cents. So it's about 2 cents short. They don't underestimate how important the 2 cents is, because consumption is more than half of the Chinese GDP. So 2 cents is actually very meaningful. So that, I think is really, there's still some cautiousness in people's consumption decision making. So that, I think, is something to do with how can we reduce this precautionary saving? How can we boost the social safety net? Almost a month ago, I came to your show. I talked about importance to have a more inclusive social safety net, especially for people retired in the rural area. I think that's still the way to go.
I have a final question for you. Looking at next year, most of the allocations into the equity market have been to Hong Kong. How do foreign investors need to think about allocating more to the A-share market?
To the A-share market. Well, I think if you look at the valuation, right now, previously it's always H-share market is more expensive compared to A-share market, right? Now it's actually the other way around. A-share market looks even cheaper. If you look at the equity risk premium, the Shanghai Shenzhen's composite index equity risk premium is 5%. 5% is historic average. It's not expensive, it's not cheap. Hong Kong depends on what you look at. If you look at the U.S. Treasury as the risk-free rate, then it's like a 4% equity risk premium. It's a bit expensive. But you use renminbi, a 10-year bond, as a risk-free rate, it's 6%. That's still cheap. So I would say whether you allocate it in Hong Kong, on the tech sector, or you allocate it in mainland, I think both are good strategies. To me, this is a big global monetary order reset is still in the process. Money are coming to China, whether it's mainland and Hong Kong. By the way, last time we also talked about whether the AI bubble, etc. I think this is nobody knows. It's detecting bubble in real time is mission impossible. The market can stay irrational longer than you can stay liquid. But what I can say is, you look at two things: whether it's boosting productivity, and whether there's borrowed money involved, other people's money involved. I think this time is probably different in the sense that very little leverage being used there. And I do fear, from my own personal experience, AI is changing people's life, changing me as a strategist, as an economist life as well. In the way coming here,
Right.
Yeah.
I used to ask my assistant, and now no use assistant. I just use my AI to find the numbers.
Now I'm curious to see if your assistant has a future in the company. We can talk about that next time. Dr. Miao, let's talk in the new year. Thank you so
Yeah.
much.
Thank you.
For the time. Yanliang Miao, their chief strategist at CICC. Still ahead here, latest talks in Ukraine make no progress towards peace. Taiwan's foreign minister speaks to us about China's role in the conflict with relations with Europe. More on that ahead.
In some world news this morning, French President Emmanuel Macron begins a 3-day visit to China today with the Taiwan issue expected to take center stage. Ahead of Macron's meeting with Xi Jinping, Beijing has been seeking support from France in its dispute with Japan over Taiwan's status. Trade will also be on the agenda, with Macron pushing the EU to deploy its toughest tools in response to Chinese restrictions on rare earth supplies. Taiwan is confident the Trump administration will allow President Lai Ching-te to make a stopover in the U.S. This comes even after President Trump was said to have denied a request for Lai to pass through the U.S. in August during a trip to diplomatic allies Paraguay, Guatemala, and Belize. Now, speaking exclusively to Bloomberg, Foreign Minister Chia-Lung said he does not foresee a similar problem in the future.
The Trump administration already showed its goodwill, and so based on our communication, so we are confident in the near future. Yeah, we can just have a visit to the Latin American countries, yeah, by way of the United States.
President Trump has suggested the Pentagon will soon begin targeting drug cartels with strikes on land in Venezuela and beyond. This follows a campaign that is largely focused on alleged trafficking vessels in the Caribbean and Eastern Pacific. Now, Trump has previously said he wants to widen U.S. military attacks against cartels that have fueled a deadly domestic opioid crisis.
I want those boats taken out. And if we have to, we'll attack on land also, just like we attack on sea. We're doing these strikes, and we're going to start doing those strikes on land, too.
Here's a look at when it comes to how the region is set up on this Wednesday morning. Hang Seng is lower, but the rest, in terms of mostly North Asia, still doing quite well, with the Nikkei and Kospi continuing on that recovery there. We're out 1% on the Nikkei and Kospi. This is Bloomberg. Checking some corporate news this morning, Taiwanese prosecutors have charged Tokyo Electron with failing to prevent staff from allegedly stealing TSMC trade secrets. Now, they're asking a local court to impose a fine on the company for neglecting its duty to stop the alleged theft. Tokyo Electron says it is still verifying the details and that the indictment targets its Taiwan unit. Tesla's China factory shipments rose for only the third time this year amid a global sales slump. Tesla shipped about 86,000 vehicles from its Shanghai plant in November. That's up 10% from a year earlier. It was the second highest monthly total this year, behind September. The gain is a rare bright spot for the EV maker as it faces subsidy cuts in the U.S. and a likely second straight annual decline in sales. JD.com's supply chain technology unit has started taking investor orders for a Hong Kong IPO that could raise more than $420 million US, capping more than 2 years of efforts to go public. Beijing-based Jingdong Industrials is set to list its shares on December 11th. It keeps Hong Kong's IPO market on track to see listing proceeds notch a 4-year high.
Yeah, that story continues to give. In fact, there's another stock, we'll tell you about that later, traded in mainland China, that's also actually falling quite a bit on the back of a Hong Kong unit IPO that is in the offing. A statement coming through out of the Chinese Ministry of Culture and Tourism. It's on the website. If you read Chinese, I believe it's in Mandarin. Anyway, that's besides the point. Unveiling these measures to boost tourism and aviation sector, particularly from countries participating in the Belt and Road initiatives. That includes things like boosting air routes, capacity as it pertains to direct flights, easing the entry and travel for foreign tourists there to come into the domestic market. Just very quickly, Samsung CNT is a story So Jay Wiley effectively was shares from his mother were shifted to Jay Wiley, and that's really leading to the gains we're seeing right now. The biggest, I believe, points contributor, biggest percentage gainer among the large caps across the Asia Pacific today. This is the China Show. Back in a moment.
11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in a moment. But yeah, this week has really been quite a volatile one when it comes to Japanese assets, right? You are seeing a rebound underway, at least when it comes to how stocks are doing. We're up 1% for the Nikkei. Topics is flat here, and we're at 155 levels, so maybe a little bit of strength coming back on the currency. But certainly the key focus has been, of course, the JGB sell-off. It's stabilized a bit now as we kind of mark the midway of this week, but we're at 187 levels, and we still got about 16 more days, 2 more weeks until that BOJ meeting. So still a lot of speculation out there of what the BOJ is going to do then as well. Are we set up for a rate hike in December or January? But yeah, how the rest of Asia doing?
I mean, they should just do it. I mean,
might as well at this point.
If it's just a matter of December or January, might as well ease the uncertainty out there.
Appease the investors out there and bond traders.
And they tend to have a habit of surprising markets anyway in December, right?
Yeah,
so might as well. If that's the case, then maybe do it in Feb. But anyway, that's besides the point. A 10 to 1%. Don't listen to my advice on that. That was just random. 10 to 1% to the upside on the Asia Pacific. It's a very weak dollar story. I know it's not showing up in absolute terms when you look at the Bloomberg Dollar Index, but when you look at certain currencies like the renminbi, which is weaker today, but it has been on the stronger side of things. You look at G10. We did get, though, some data today out of Oz, GDP numbers also, by the way, I think in South Korea also coming out today. Right. Setting that aside, it's generally an uneventful markets day, which gives us, I think, more time to focus on some key themes that have re-emerged of late.
Yeah, Wanka certainly is the big one here, and whether there is this sort of renewed sort of concerns around the property market. Is this the next phase of market clearing, for example? That certainly is one question the market is asking for here right now. Bloomberg Economics has come up with their take on all this, and they're saying, China Wanka's potential default could wipe out any remaining belief in Beijing's implicit backing for the sector. For more insight on the long-term gains and short-term risks, let's bring in David Chu. He's with us right now on what the potential sort of ramifications are of really letting Wanka go. What do you think is going to be the biggest sort of impact?
Yeah, for Vanke's case, I think we think that the most important risks is not in the credit market, but in the housing market. We all know that China's housing market has been sluggish for a couple of years, and now if we have another major developer defaulting in the market, it means that it will again reduce the confidence in the housing market, so that to drag the sales again. But in the credit side, we think that the market has largely priced in the financial stress in Vanke. And also, we have seen a lot of defaults over the past several years, so that I think the credit market react should be manageable.
Okay, so what's your suggestion then?
Well, it's hard to give a silver bullet here, but I think the government should stick into the market principle that because they have used a lot of money to help Vanke. And I think maybe they can consider another solution here. But whatever it happens, I think that the market, the government need to continue to support the housing market to prevent a crash in the market, because you have seen that the market has been so soft, and the prices of the housing has been going down for more than 3 years, so that a continuous support is still needed.
And David, there's been a lot of chatter about what sort of policy levers authorities still have in terms of reviving this property sector. I think this prospect of mortgage subsidies, how substantial does it have to be to really kind of spark some sort of revival?
Well, I think the market has been talking about the mortgage interest subsidy by the fiscal. Well, I agree with that, but I think it's not important. It's not enough to boost the or to reverse the downturn of the housing sector. The key issue in the housing sector is the oversupply in the low-tier cities, such as the Tier 3 and Tier 4 cities. And the government actually has done a lot of effort in the past years, such as provide lending to local government to buy the oversupplies in the market. But it seems that all of these policies are not enough to push back the housing sector. So that I think, anyway, we need more support from the government, and it also needs more time.
Yeah, but we've been waiting for quite a bit too. David, thank you so much for setting us up. It's a story certainly we'll continue to be on top of going into next year. That's just also to mention Robin Ching, who comes in the show quite regularly out of Morgan Stanley. There's a story out on the terminal that talks about this. So I think he had this, I believe, a conversation with reporters in Beijing to talk about what he thinks should be part of the solution here, I think, to the point you're making on mortgage subsidies.
And as David mentioned, right, it's all about the size and scope of whether, to determine the effectiveness of these sort of mortgage subsidies, right? And he says really you have to spend about 400 billion renminbi a year to really kind of lift the sort of battered, confidence when it comes to consumers. So they may take a more gradual and flexible approach when it comes to the fiscal side of things, but they say mortgage subsidies is just one option that could be rolled out here for the property market.
Yeah, and I think the one measure he's putting forward is, if you want to measure progress or, do I rent? Let me put it simply, do I rent or do I buy? And I think what he's saying is you have to lower the borrowing cost to parity, if not lower, to bring borrowing costs in line with rental yields. And I think that then makes that incentive prism more in favor of buyers.
Yeah, for more in terms of the property sector, let's talk about what this means for the banks, of course, here. Mei Yan, head of Asia Financial Research at UBS Investment Bank. In terms of the property exposure this time around for some of these Chinese banks, what is sort of your take so far?
Yeah, we have analyzed the impact, downside impact from both the corporate developer loan exposure as well as the residential mortgages and individual operating loans. So we do expect roughly more than 2 trillion RMB losses on the banking sector from the developers' loans to developers or the shadow banking investment they did with the developers. So Vanke would be one other that added to the how many 70, 80 of them already defaulted, right? So so that would already be in our forecast for the next couple of years. Credit costs for the banks. So our view is that actually the Chinese banks, on the positive side, the revenue is bottoming this year and is going to turn into positive growth next year. Last 5 years they have
the revenue drop, you mean?
The revenue drop, yeah. Okay. Last 5 years that they've been seeing declining revenue since COVID. But this year is the bottom, and it's going to turn positive growth in the next 5 years in our forecast. And that will help them to rebuild more reserves, that the reserves can be used to cushion for all of these NPLs.
And of that, what was that number again, 2 trillion that you mentioned?
About 2 trillion RMB in terms of developer loan losses and shadow banking investment losses.
How much of that has already been
provisioned?
Yeah. So how much do we know about already?
The banks have provisioned more proactively ahead of the NPLs that they have recognized. The NPL ratio reportedly is only 4 to 5% for developer loans, but some of the banks have provisioned up to 14-15% for their loans. So I think more than half. More than 1 trillion has been provisioned by the banks already.
Okay.
What's more important? I mean, when we determine the NPL sort of ratio, is it more about cash flows, or do I look at property price declines moving forward?
For the residential side NPLs, we think cash flow, income, and job security, jobless rate is more important. As we referenced to the Hong Kong banking history in 1997 to 2003. So property price dropped 68%, and 30% of people in 2002 already have negative equity. But the delinquency ratio was only as high as 1.4%. So it's important for cash flow whether they can coverage their they cover their mortgage payment or not. So from that perspective, we actually recently wrote about this, that we think the mortgage NPL will go up from currently about 1% to 1.6% in 2027. And the residential property-backed individual operating loans NPL will triple from right now 1.8%, 1.6% to 4.8%. And the banks will need to provision for that. But the provisioning, which is roughly about 900 billion that's needed, is also in our 5-year forecast, which we think the banks will be able to manage that. The only, I think, the risk is whether the orderly sort of resolution of the property pressure. It's okay for the banks to measure, to afford, but if there's going to be a crisis or a collapse situation, that will be something that bank will be difficult to handle.
I mean, the market, just to use the Vanke example as one example, but not specifically on that case. I mean, the market's trying to figure out how Vanke is able to meet its liquidity needs, right? And is it in the bond markets where that doesn't seem to be a good option, because looking at where bond prices are, is the banking sector still a viable option for many of these developers to tide them through in terms of their ability and willingness to extend those loans?
Banks are asked by the government to support the property sector, and so in the last couple of years is not to early recall their loans, to take back the loans.
Yeah.
So they've done that, and but not really adding too much additional exposure. So I think they are more willing to help on the mortgage side because the collaterals are more safer. But on the developers, I think they will need to go through restructuring, as the Vanke case will turn out to be. I think for most of the defaulted developers, at least the offshore bonds had a haircut of 90% or so. Yeah. So recovery is very low. So you need to cut their debt to be able really helping them. Just extending the loan or the bond is not going to help.
Yeah, we talked about mortgage subsidies. Anything that you think in terms of the policy side that could actually reduce risks?
Yeah, I think there's 2 or 3 things that's already in the pipeline, where the central bank governor Pan Gongsheng has mentioned about removing some of the default history for the individuals since COVID happened 2020, that they have defaulted on smaller amount, but since then repaid. So because China doesn't have a personal bankruptcy law system, so they may never emerge out of that. So the central bank is studying to remove that record. That will help them on the buying mortgage again, or
so like a credit score.
Yeah, credit scoring system. And then secondly, the Ministry of Housing have announced that they will deliver 7.5 million units that has been stopped or suspended, and that seems to be on pace. That's on track to happen. That helps too. But other than that, I think eventually you will need another rate cut on the mortgage as well, be it the subsidy from the Ministry of Finance or from the banking system again, because there are 2 times already on the cutting rate of mortgage rate on the existing mortgage book, because you need that, what's mentioned earlier, 2% or less of mortgage rate to clear the property market, because the rental yield is roughly about 1.8% or so.
That's good to know, actually.
Yeah.
Okay. So you talked about revenue growth. We're probably going to be positive next year. Can I ask you, 2026, overall the sector profit growth, how much? And the dividends that people have been playing this year, does that remain a play next year?
Yeah, that's the key. I think what's supporting the Chinese banks' stock price is the dividend sustainability, where in our 5-year forecast, actually, we do think they can maintain the DPS, after, of course, the capital injection dilution, but they can maintain the DPS. And so the revenue, our forecast next year is roughly growing at 1 to 2%, and eventually grow to 4 to 5% by 2029. So it's an acceleration of revenue growth, because I do think the net interest margin compression is getting smaller and maybe plateaued sort of by 2027. That supports, and the fee cut also is coming to an end. So so the revenue, and then banks are doing more of treasury operations to make gains on the bonds. Yeah, so revenue growth is looking a bit more positive, but they will not pass all the 4-5% revenue growth to the bottom line net profit. Rather, net profit growth will still be about low single digit, 1 to 2%, because they will need the gap to rebuild the reserves to absorb all these NPLs.
May, it's always fantastic to really get geeky on the Chinese financial sector. May Yan there, of course, head of Asia Financials Research at UBS Investment Bank. Perfect outlook as we go into next year. We'll take a short break. Back in a moment. A look at markets, down 1% or so on the Hang Seng Index and peers. Slightly less when you look at A-share markets. This is the China Show. Right, an update here on Russia. Russia has dashed hopes of immediate progress, at least towards a Ukraine ceasefire deal, saying talks in Moscow between President Putin and U.S. envoys could not reach an agreement on what the Kremlin calls, quote, territorial issues. Putin met with Steve Witkoff and Jared Kushner for almost 5 hours. His foreign policy aide says the wording of some U.S. proposals is not acceptable and work will continue. Axios says that the U.S. team is expected to meet Ukraine's president somewhere in Europe after leaving Moscow.
Meanwhile, Taiwan's foreign minister says Taiwan and Europe share common security interests after Russia's invasion of Ukraine and calling China a, quote, decisive enabler of the war. Then Chia-Lung spoke with us exclusively about opportunities for closer ties with Europe.
I think in terms of our diplomatic relation with European countries, it's full of room for mutual cooperation for three reasons. The first one is the Russians' invasion of Ukraine. So now European countries are facing the threat from Russia, with China being the decisive enabler behind the war.
Decisive enabler.
Yes. And now we have a common interest in terms of security. So because Europe and Taiwan's trade are interconnected with each other right now. The second one is the President Trump's approach toward NATO. Because President Trump repositioned its strategic view to shift to the Pacific. So to ask European countries for more burden sharing in terms of defense budget. For example, by the year 2035, 5% of the GDP in defense spending. And also, I think for Taiwan to be an indispensable partner for the European countries, we not just share common values, but we have strategic interest in terms of the restructuring of supply chain resilience.
Right. How about finding other nations to cooperate in chips? We do know the United States, there are TSMC plants being built in Arizona. We know in Kumamoto, Japan, also new fabs being built there. What is going to be the diplomatic efforts from your department, your ministry, to further those aims? And what other negotiations are you having with other countries for diversification and chip cooperation?
I think for Taiwan to work with other countries, we want to show our goodwill in terms of cooperation on the semiconductor supply chain resilience. So for those countries such as the Philippines, we have a very good relation with the Philippines. So we also have some, already I think some projects on talent cultivation.
APEC obviously is going to be held in China next year in Shenzhen, but there's going to be, rather than till the end of the year when you're going to have the leaders visits summit, you're also going to have many different ministerial level meetings. Is that something, given Beijing's insistence that you be called Taipei China, Is it something that you feel Taiwan will participate in China, sending ministers to China?
I think we will participate in next year's APEC summit held in China. But I think as a host, China should abide by the APEC guidelines, regulations, and I think all practices, in line with I think equal participation, including Taiwan. So once China want to downgrade the participation of Taiwan, I think we will try every effort to protest, to coordinate with our like-minded countries to act for equal participation. As a host of the next year's meeting, I think China should behave, and we will work with I think other countries to fight for our rights for equal participation.
Taiwan's Foreign Minister Chia-Lung there speaking exclusively with our chief North Asia correspondent Stephen Ingles in Taipei. And if you are a subscriber and want to rewatch that interview, you can do so by watching our interactive TV function, TV Go. You can also become part of the conversation by sending us instant messages. This is Bloomberg.
Right, we're looking at magnet-related, rare earth-related stocks. First cohort here, at least 3 producers have been granted export licenses that now enables them to then accelerate back to the conversation from Korea about 6 weeks back already. Shipments following the truce between U.S. and China. That's according to Reuters, citing an unnamed source there, but shares are broadly to the upside against the broader decline across the benchmarks here. Yeah.
Yep. So watching, of course.
This is the one that's
the one that filed for that Hong Kong listing. This is Shenzhen transition filing there. So the stock is down some 7%. We're also watching that Singapore debut when it comes to fluorescent technology and the like. Ultra green AI still doing quite well in Singapore. First day of school, we're up some 8% as well. So certainly that's one to watch, but it is kind of slow going here. But one thing to watch, of course, we talk about the renminbi, the strength there, is the other side of it is the weakness in the rupee, right? We hit that record low yesterday as well, and we're inching very close to that 90 per dollar mark. And it really, the signs of really whether we get a trade deal or not are very contingent of where the rupee goes now, because I think at this point you're seeing the RBI step back in terms of really deploying their reserves to defend the currency if there is no trade deal in place. So that certainly is one thing, a good big headwind really for the currency.
Yeah, one level to watch, which is very simple. It's just 90 level. That's it from us here on the China Show. It's the birthday of our producer, by the way, so happy
birthday, Sam.
We'll see you all tomorrow.